the paper markets were the tail on the dog, but the tail constantly wagged the dog because they would overwhelm the physical markets with paper. The problem now is they've done it for so long and to such a grand extent that now there's a question whether these paper contracts are going to be able to deliver. And the answer, I think, you're going to find in the next month to 3 months, we're going to find out that no, the paper markets are not a substitute for real physical because they have to deliver real physical that does not exist. The bottom line is all of the futures, options, paper products, etc., they're all based off of the physical metal in the first place anyway. That's why they're called derivatives. They're derivatives of the actual product. There's not as much concern. There's concern. I mean, if gold doesn't deliver, the system dies anyway. But if gold doesn't deliver, it's not a direct effect on production, if you will. Silver is used in so many different applications, whether it be industrial, technological, medicinal. I just did an interview was talking about every time they shoot a Tomahawk missile, there goes a monster box. You can't make a Tomahawk missile without roughly 500 ounces of silver. So silver will have profound ramifications to the real world, to the real economy. Now, that said, if silver goes failure to deliver or gold goes failure to deliver, you're stuck in the casino because the casino will close. And when the casino closes, and we've talked about this, for the last, year and a half, maybe even 2 years, we've talked about the great taking. Once the casino closes and banks and brokers and insurance companies start going belly up, they're going to take your capital with them. And that's why it's so important to get your capital out of the system into something, gold and silver, that cannot bankrupt, and in a place where it can't be taken from you. Going back to visit the late 2019 episode, that was just before COVID, and the repo rates spiked to 10%, and the Fed was having to put $100+ billion into that market every single night so it could clear. Then conveniently along came COVID, and two things happened. The real economy worldwide was definitely stunted or shut down, whatever you want to call it. There was less demand for credit because of COVID, and it allowed central banks all over the world to flood the markets with liquidity. Problem solved. Not solved, but the can was kicked down the road. Here we are again. We're nowhere near where we were in October of 2019, but the overnight rates are starting to move higher again. It's a concern and should be watched. Again, everything, whether it be the real economy, production, consumption, transit, and also the financial world, the financial economy, everything runs on credit. If credit gets disrupted or credit ceases anywhere, it'll shut the whole system down. We have interest rates still at basically generational lows. I mean, we're not where we were 3 or 4 years ago. We're not at 0% rates, but rates are extremely low. There's no risk premium in interest rates at all. So brokers and banks, they understand that the likelihood long-term, 5 years, 10 years, longer than that, the likelihood is that rates are going to go higher, not lower. And they also understand that there's going to have to be another mass printing, whether they call it QE or not, it doesn't matter. But there's going to be another global mass printing. And the problem with that is that debases the currencies, and that lowers the value of the unbacked currencies. If the values are lower, then you got to give more of dollars or euros or yen or whatever for that same ounce of gold or the same ounce of silver. So I think they're looking at it pragmatically and saying, yeah, the day of buying and holding bonds is over. And that's why they're recommending half of that bond position be liquidated and put into gold. The only problem with that is if everybody did that, you'd have gold at probably, who knows, $2 million an ounce. Just, pick a number, but it's going to be super, super high.
It's funny. For years, we've said that the paper markets were the tail wagging the dog. But today, that tail has grown so oversized, so bloated with leverage, that it's not wagging anymore. It's strangling the dog. The futures, the ETFs, the synthetic options. They were designed as derivatives of the real thing. That's what the word means, something derived from something real. But the problem now is that the derivative markets have become so much larger than the underlying physical market that they've swallowed reality itself. Here's the hard truth. We've been pretending for decades that you can print silver and gold the same way you print currency. Every futures contract, every options chain, every synthetic long position represents someone somewhere promising metal that doesn't exist. And that's fine until it isn't. Because at some point someone says, okay, I'll take delivery. And that's where we are now. The paper markets have reached their breaking point. The cracks are showing. In the next few months, maybe even the next few weeks, we're going to see something the mainstream press won't know how to explain. Failure to deliver. Not a rumor, not a technical delay. A genuine, there's no metal left to send. That's when the paper illusion dies. Think about it. All of these futures, ETFs, and options, they're all built on the same foundation, which is the promise of physical delivery. But you can't deliver what doesn't exist. The entire system is a hall of mirrors, and when one of those mirrors breaks, the light doesn't reflect anymore. Gold's tightness is dangerous enough, but silver's a different beast. If silver fails to deliver, the consequences go far beyond finance. Silver isn't just money, it's infrastructure, it's medicine, it's technology. Every time the US military fires a Tomahawk missile, that's about 500 ounces of silver gone. Every smartphone, every solar panel, every medical sterilization unit, all of it needs silver. You can't run modern civilization without it. So imagine what happens if silver goes no offer. You can't get it at any price because there simply isn't any available. You're not just looking at higher premiums, you're looking at production lines halting, energy systems failing, and technological progress freezing. Silver is the industrial fuse in the world's electrical circuit, and that fuse is starting to melt. If the paper markets fail, if the COMEX or LBMA experience a genuine failure to deliver, it won't just be an inconvenience. It'll be the financial equivalent of the power grid going out. Because remember, this whole system, the banks, the brokers, the insurers, the shadow lenders, they're all sitting in the same casino. And when the casino's chips turn out to be counterfeit, the doors get locked. That's what I call the great taking. The system is set up to make sure that when things go bad, your capital becomes their collateral. You might think you own your brokerage account or your bank deposits, but read the fine print. You're an unsecured creditor. When the system freezes, your assets become their bailout. That's why I keep shouting this from the rooftops. Get your wealth out of the system, out of the banks, out of the brokers, out of the paper contracts, into something you can hold, gold and silver in your possession. That's what survives a system reset. Let's rewind to 2019 for a minute, because that's when we saw the first major crack appear. Remember the repo market spike? Overnight lending rates shot up to 10% in a system that supposedly had plenty of liquidity. The Federal Reserve had to inject over $100 billion a night just to keep the pipes flowing. That was the moment the interbank trust mechanism broke. Banks stopped trusting each other. Then came the convenient solution, COVID. Suddenly, the whole world was locked down. The real economy slowed to a crawl and credit demand evaporated. That gave the central banks cover to do what they always do, flood the system with liquidity. Trillions in new currency appeared overnight. They didn't solve the problem, they just hit pause. They kicked the can down the road. And now, here we are again.
That brings me to a topic I want to talk about. In silver, I've been an advocate of junk silver as the best form to own in the United States. Roughly 14 dimes equals an ounce. So you've got 14 transactions. It's the smallest denomination. It's U.S. Mint lineage. It really can't be counterfeited because it's got to show scruffiness. I mean, these were in people's pockets. And we've got an anomaly going on right now where if you're looking to sell junk silver, you're looking at $3.50, $4 under spot. And if you're looking to buy junk silver, you can buy it at spot, maybe 50 cents over spot. It's the cheapest form that you can buy right now. So if you're buying silver, you definitely want to buy junk silver It's the cheapest and it's the best. And if you're worried because the bid is below spot, and it's well below spot, pretty much everything else is very close to spot, or even eagles are above spot. Understand what has happened. We finally got back to this $50 level, and we stayed here. We've been here for, call it, a month, but we're approaching it. And literally, I'm not going to say the only form or the only way to buy silver in the late 1970s, early 1980s was junk, but that was by far and away the primary form of silver to buy. So what you've seen over the last few months is that many of these people who have held on for 40 plus years have turned seller, and the dealers and the wholesalers got overwhelmed with the selling. So what did they do? They lowered the price, and if they're, call it $4 under spot, that's 8% below spot. And what they're doing is they're sending those coins into refiners to melt them down, and they pick up that 8% is what they're doing. That said, this is a short-term event because the supply is already, the supply of junk being sold is already starting to dry up. And when it does dry up and prices start to normalize, guess what? There's way less junk available that still exists because it's been melted down. And I'm gonna say right here that I think when all is said and done, junk silver is going to become the most expensive form of silver in the United States, even priced higher than eagles. And I say this because I believe the supply is being destroyed on a daily basis.
The backlog that then occurred at some of these refiners that then currently made it.
Yeah, there's a backlog. I mean, the amount of junk that has been turned in for sale has been huge, and it has backlogged the refiners. This will pass, and when it does pass, I think, like I said, I think junk will end up being the highest priced silver in North America.
The funny thing about crises is they always start where confidence ends. And we're at that point again. Confidence in government? Gone. Confidence in fiat? Fading fast. Confidence in the paper financial system? Hanging by a thread. But here's the catch. The system needs your confidence more than it needs your capital. The whole thing runs on faith. Every treasury bond, every derivative, every bank deposit, it's all just an IOU. It's not backed by anything real. The minute people start demanding delivery, the illusion collapses. And that's exactly what's happening in the metals markets. Delivery requests are rising, open interest is shrinking, and physical inventories are draining. The COMEX warehouses are a fraction of what they were a decade ago. London's LBMA stocks are down over 70% since 2020. That's not a market imbalance. That's a market running on fumes. We're already seeing signs of stress. Remelted silver bars being recast and redelivered just to fulfill contracts. Allocated metals being double counted across ETFs and central bank custodians. Refiners reporting months-long backlogs. These are not the symptoms of a healthy market. They're the signs of a dying one. The truth is, the West's entire financial structure has become one giant margin call waiting to happen. And when that call comes, the margin clerk will be reality itself. Now let's talk about credit, because credit is the bloodstream of this beast. Everything we do, every mortgage, every car loan, every inventory shipment is financed on credit. And when credit tightens, arteries clog. It's the same pattern we saw in 2008, the same pattern we saw in 2019, and the same one we're seeing again now. But this time, the stakes are higher, because there's no ammo left. Debt levels are beyond comprehension. $35 trillion in the US alone. The Treasury is rolling over $10 trillion a year in short-term notes just to stay solvent. That's like taking out payday loans to pay your mortgage. Meanwhile, the bond market, once the foundation of global stability, has turned into a house of cards. Long-duration bonds are collapsing. Yields are rising not because the economy is strong, but because the world is losing faith in the promise of repayment. And when faith goes, velocity follows. Investors start moving faster and faster, chasing anything tangible. Commodities, land, metals, energy. That's what we're starting to see. The Federal Reserve will have no choice but to print again. They won't call it QE, of course. They'll dress it up with a new acronym: Liquidity Support Program, Market Function Facility, Emergency Reserve Adjustment. But it'll be the same thing: digital money creation to plug a black hole that's swallowing the system. And every time they do that, the purchasing power of the dollar erodes further. That's not a conspiracy. That's arithmetic. When you create more units of something, each unit becomes worth less. That's why gold's rising. That's why silver's coiling. That's why central banks themselves are hoarding metals while telling the public not to. Now let's talk about the great taking, because people need to understand what's really at risk. When this system seizes up, and it will, your assets on paper will become collateral for someone else's liabilities. Your brokerage account? It's not your stocks. It's your broker's claim on a pooled asset base. Your bank account? It's not cash in a vault. It's a liability on a spreadsheet. When the dominoes start falling, those liabilities will be bailed in. That's the technical term. Bail-in. It means they take your deposits to cover their losses. It happened in Cyprus, it's happened quietly in multiple European banks, and it's written into US law under Dodd-Frank. That's why owning physical gold and silver isn't just smart, it's survival, because they're the only assets that can't default, can't be hacked, and can't be printed. Here's something I tell clients all the time. When the system breaks, you won't have time to react. You won't get an email from your broker saying, "Hey, things are getting dicey. You might want to withdraw your funds." It'll happen on a Sunday night. The markets will close on Friday, and by Monday morning, you'll wake up to a message saying, "Access temporarily suspended." That's how every credit freeze starts. You want to know what that looks like? Go back to March 2023. Silicon Valley Bank collapsed over a weekend. Depositors were frozen. Businesses couldn't make payroll. The panic spread like wildfire. The only reason it didn't become systemic was because the Fed stepped in with a $400 billion liquidity backstop in 48 hours. That's how fragile this system is. Now imagine that same event, but at a global level. That's what happens when the paper metals market fails. And here's the irony of all this. We were warned. The repo market in 2019 was the first tremor. The COVID lockdowns bought time, but they also created the inflation bomb we're now living with. And instead of addressing the underlying credit dysfunction, central banks doubled down on printing. They've now boxed themselves into a corner where every solution makes the problem worse. Raise rates and they implode the bond market. Lower rates and they ignite hyperinflation. There's no way out. The only path forward is a revaluation, and history tells us that revaluation always begins with gold and silver. So let me be very clear. This isn't about getting rich. It's about staying solvent. When credit implodes and currencies collapse, the only things that retain value are real assets. You can't eat digits. You can't heat your home with ETFs, and you can't bribe reality with derivatives. But an ounce of silver, that will still buy something. You know, people ask me sometimes, "Bill, what do you think gold will go to?" And I tell them, you're asking the wrong question. The question isn't how high gold or silver will go. It's how low fiat will fall. Because when your measuring stick is burning, the numbers don't matter. In real terms, gold could hit $1 million an ounce and still not make you rich. It'll just mean the dollar died. What makes you wealthy is owning something before that happens. I'll leave you with this thought. When trust evaporates, money returns to its natural state: physical, scarce, and real. We've seen it in every empire in history. The Romans clipped coins. The British debased sterling. The Americans printed the dollar into oblivion. Every time the end was the same. Paper wealth vanished and metal endured. So don't wait for the headlines. Don't wait for permission. Get your capital out of the casino and into reality. Because when the music stops, and it will, those holding paper will find themselves locked inside, while those holding metal will already be outside, watching the fireworks from a safe distance. That's not doom and gloom. That's history, and it's repeating right now.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.